Jim in Los Angeles asks, what about regular bonds? Is it time to get out of short-term bonds for a longer term? What happens if rates get cut in the future?
Jim, thanks for the question. Yeah, I think bonds are really interesting. Safe money investing is more appealing today than it's been in 20 years because interest rates are much higher than they were a year ago. If you look at CDs and savings accounts, you're getting 4 to 5% versus a year ago, you're getting paid less than 1%. So there's a lot more opportunities for a safe money investor, and bonds are one of them. A lot of people have piled into short duration bonds. But as the Fed gets closer to saying enough is enough with raising rates, intermediate and longer term could become more appealing. You're not going to get a higher rate, but you could get potentially more appreciation potential. And I think the thing to remember as a short term safe money investor is what is your reinvestment risk? If you buy a 1 year CD, if you buy short duration treasuries, and if the Fed cuts rates a year from now or 2 years from now, and now you can only reinvest that at 2% or 1%, how does that change your investment thesis and how does that play into your long-term picture? So I think you need to start thinking about having a more intermediate to longer term view about your bonds. You're not going to necessarily make more money in yield, but you might get some appreciation potential if the Fed cuts rates in the future. Some appreciation potential and get some of those higher yielding instruments.